So if you are making journal entries, adjusting entries, so what happens is, so what he's asking, he's saying he's worked in the real world for a long time, and he's worked in these accounting systems, right? So when you take this, so I'm showing it to you in a nice little PowerPoint here, and he's saying in the real world, we don't really see the general ledger, the general journal, like what is that? Okay, so what happens is, most people in your company are, they work in these subledgers, right? So if I work in an accounting department, we'll keep it to the simplest of examples, right? So I'm a controller in an accounting department. I have below me working an accounting manager. There's somebody who takes care of the payables and somebody who takes care of the billing side of things, okay? So those people, so the payable person, they receive the bills and they enter them into the system. And they enter detail. They enter, we owe money to Joe's Auto Body. We owe money to Keurig Coffee Company. We owe money to, yeah, right. We owe money to the HVAC company for the air conditioning that we use, whatever it is, okay? So they get bills. And they enter all the detail. They enter the name. I'm trying to just make this real for you. They enter the name. They enter the address. They enter the amount of the bill. They enter the date it's due. All this detail. Have we looked at any, have you seen that in anything that we've talked about so far? You don't see that detail, right? Okay, that's in the subledger. So they enter all that detail. On the billing side, there's a person who handles the billing. So a transaction happens, and so when I was in California and I was working at this movie studio, we would have tenants that would come in to rent the space to shoot a movie. And for their rental, they would have to pay, if it was a big movie that was coming in, like a major motion picture, we would rent them air conditioning on a monthly basis. We would rent them stage managers on a monthly, stage manager rates on a monthly basis. They would have their monthly rent, all these different charges that they would have for dumpsters that they would use to clean up their sets, all these different things. There's a whole variety of things. The billing person would get the information that would have to be billed. They would enter it into the system. This is for, Lemony Snicket's, the series of unfortunate events. They would enter all the information under that client. They would enter the, all the detail, okay, for that client's billing information. So both of these, they're doing this on a daily basis. At the end of the day, at the end of the period, whenever we decide, a weekly basis, whatever the process is, you post into your general ledger. So that's where all the detail is. The posting that goes into the general ledger is a journal entry. So on the payable side, all the information that they enter for Joe's Auto Body, let's say we owe $1,500 for Joe's Auto Body. So the posting into the general ledger says whenever they would choose the accounts, okay? They would say that's maintenance expense. Or maybe Joe's Auto Body is automatically guided into maintenance expense or something. They're not doing a lot of work there. They're just entering this detail. They don't see the picture behind the scenes where I've set up the accounting system to make journal entries that post to the general ledger. So when I click to post it, they don't post. When I click to post, what happens is suddenly in the general ledger system, that's a third module. It goes in there and it says maintenance expense, accounts payable, right? Actually, it doesn't even give you that much detail. What's going to end up happening, it will really take the total of Joe's Auto Body, Keurig Coffee System, blah, 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 and it will post one big journal entry to credit payable, and then it will give you all the individual expenses that it goes into. If I want detail on what's in that payable account, I have to go into the subledger and print an accounts payable detail. Okay? Yeah, Peachtree Peachtree and QuickBooks. These are like very commonly used, but they're very simple. What I'm talking about and what he's talking about are like these huge, right, these like enterprise, these really big enterprise systems that are very common in large corporations. There are like mid-range. QuickBooks and Peachtree you can buy off the shelf. They're great, but they don't have the controls in place that these large systems would have. So they're wonderful if you're a small business. Absolutely wonderful, for those types of things. But you could like do whatever you want and like reverse whatever you want and change. You can't do that in these systems. Right, there's a lot more controls in place. Yes. So now the billing person, same thing. The stuff comes over. So into the general ledger module is like a big journal entry, but you can't get all the detail. You want detail, you have to go into the subledger. So it tells you, it'll get you the total revenue into your general ledger. So now, at the end of the period, getting to the point of what I was, the whole point of all of this. So at the end of the period, you have to make adjustments. So let's say payroll comes in. Payroll is a really easy one, I think. So payroll comes in, and normally the person who does the payables will enter, say, that payroll entry. Okay, we'll enter the payroll, say, through the accounts payable system. Okay, whatever. The payroll comes in, but it's not coming in until 5 days after the end of the period. Okay, so there's 2 days of payroll. So let's say payroll is $700. It's $100 a day, and it's not going to come in until 5 days after the end of the period. So what's your payroll expense for the first 2 days that you haven't that's been incurred but hasn't been recorded? $200, right? So what happens is I say to my payroll person, I don't say to my accounts payable person, you're going to need to make an adjusting entry, and then we're going to have to do all these things. I don't involve them. They have a process that they do. Okay, I go in and I say, okay, into the general ledger system itself, where nothing really happens. Everything actually really happens in these sub-ledgers and just posts into the general ledger, right? That's where all the real details and everything that's happening is happening in these sub-ledgers. Nobody touches the general ledger unless you're like at a higher level of understanding about how everything works, right? Right, exactly. Because here you're bypassing all the controls. So if I want to make this $200 entry, I make it directly into the general ledger. I debit payroll expense for $200. I debit accrued payroll by $200 at the 31st. At the first, at the same time, I make a journal entry for the next day that reverses it. Because then when payroll comes in, they just do whatever they normally do. And what it did by reversing it, it nets the payroll expense to $500. See what I'm saying? So I debited payroll expense and accrued payroll on the 31st, and I debited payroll and credited expense on the 1st for $200. Now when they do what they normally do, how much are they going to debit expense for? $700, and the net effect is going to be $500. That's a reversing entry, and that's why they're done. Okay? That's why they're done in the normal course of business, because you don't necessarily need to involve everybody and say, well, you need to go and know that I accrued $200 of that payroll, so you only make a journal entry for $500. That can be very confusing because there are lots of different people with lots of different roles. So I hope that answers your question about how the general ledger sort of fits in, and so that's like the big picture with the adjusting entries that we were talking about last week.
See, I was looking at the general journal as a record.
Right, but really that's not done. Like if you use Peachtree or you use QuickBooks, then your general journal is an important thing because it's not this controlled thing that has different modules. A lot of stuff is then entered into the general ledger, or you could do it that way. You could they have modules, but they're just not that sophisticated.
Yeah, a lot of times what we did was we may have had invoices that didn't make the close, or there may have been some expense that's been incurred where we have to process the invoice. We have a contract on it. And when you accrue the expense into the appropriate period, you reverse it because you know it's going to be.
That's exactly like payroll. That's exactly the same example that I gave with the payroll. Exactly like that, right? And so that's very common.
And actually, when you do it later on in these environments, you're entering in the journal and you're marking as a reversal. It's going to reverse automatically.
Right, exactly, right. A lot of these systems allow you to do that. So, so just moving on from the adjusting entries. Now that you've done all this, now you have you can create financial reports that are hopefully accurate because they include all of your adjusting entries. So income statement is the one we're starting off with. I'm just showing you. I'm going to show you all these different ones. So we have the income statement, and the income statement includes revenues and expenses, which I shouldn't have put this here. I should have made you tell me that these are not permanent accounts. They are temporary accounts, and that means what? They get closed out to income summary at the end of the year, right? So at the beginning of the year, you come in on January 1st, should your revenue and expense accounts have any balance in them yet? If you come in right in the morning before any business happens, right, they should have zero balance. Okay? So here you report on your income statement. This is called a multiple step income statement. We're going to talk about multiple step versus single step when we get into income statement, that chapter, chapter 4. But here is a multiple step income statement. It shows sales minus cost of goods sold. So you have a subtotal here at gross profit. You separate out your operating expenses from your non-operating expenses to come up with net income. You don't need to worry about the details here for now. I'm just showing you this is a financial statement, an income statement, and it happens to be a multiple step income statement. Okay? Versus single step, which we can call the simple step. Okay? Income statement, oh. I love it. I'm like, wait, I thought we were doing balance sheet. How many times am I going to do that every